Hello everyone, I Karishna Suvarnakar welcome you all on behalf of MI Capital Services to our new series on UAE corporate tax simplified for you. We bring to you a series of videos simplifying the proposed UAE corporate tax for better understanding by sharing our insights on the same. So let's start without wasting any time. Today, I would be explaining about the calculation of taxable income that will include the basis of calculating taxable income, the treatment of unrealized gains and losses, exempt income, deductible and non-deductible expenses. To begin with, the basis of calculating taxable income, the proposed corporate tax regime keeps it very simple, saying that the accounting profit or loss as stated in the financial statements will be considered as taxable income for levying the corporate tax. Now, the financial statements should be prepared using the accounting standards and principles that are acceptable in the UAE, and the businesses can use accounting year or financial year as default tax period. Now, IFRS are commonly used in the UAE, and the financial statements are prepared in line with the IFRS. However, any alternative financial reporting standards can also be used for calculating the taxable income under the proposed corporate tax regime. Now, the financial statements of an entity shall present fairly in all material respects the financial position, the financial performance, and the cash flows in line with the requirement of the IFRS and other financial reporting standards as followed by the business. Now, under the IFRS, businesses can revalue certain assets or liabilities under certain circumstances to give the correct or the actual value and change in the value of items. For example, company can apply an accounting policy to measure the investment property under IAS 40, that is investment property at fair value, or measure the property, plant and equipment under IAS 16, that is property, plant and equipment using the revaluation model. Now, application of such policy gives rise to accounting of unrealized gains or losses on such balance sheet items. Now, such accounting is made just based on the accounting principles when in fact there has been no physical evidence for change in the value, no transaction has taken place for the same, and no lease or sale of such property has taken place. Thus, it has been proposed that such unrealized gains or losses from the capital items will not be taken into account while calculating the taxable income for the corporate taxation, as they have a long-term impact on the business. But however, sometimes these unrealized gains or losses may be on the revenue item as well. Now, revenue items have a short-term impact on business, and these include items such as goods or services the business sells in the ordinary course of business. Such unrealized gains or losses in revenue items will be taken into account while calculating the taxable income for corporate tax. Coming on to the next important topic, that is exempt income. Now, rather than what is taxable, everyone is always interested in what is exempt. So let's have a look on exempt income. Now, as discussed in the previous video, worldwide income of the UAE resident company will be taxable to corporate tax, which gives rise to double taxation in the hands of these companies, and thus to eliminate this hardship. And as an international practice, certain exemption from taxation has been granted to these companies. Now, exemption from UAE corporate tax will be certain as follows. Very first, income earned by UAE companies from its subsidiaries by way of dividends on investment and capital gain from sale of shares, subject to two conditions to be satisfied, and these two conditions will be granted only on the participation exemption. Number one, the UAE shareholder company must own at least 5% of the shares of the subsidiary company, and the foreign company, that is the subsidiary company, is subject to corporate tax or any equivalent tax of at least 9%. Second exemption from UAE corporate tax will be domestic dividends earned from the UAE companies. That is, other than subsidiary and associate companies, if you are earning dividend from these companies, that will also be exempt including dividends that is paid by the free zone person, that is the free zone person which is being benefited from 0% corporate tax regime. Number 3 exemption is dividend paid by foreign companies and the capital gain from sale of shares in both UAE and foreign companies will also be exempt from the corporate tax provided certain conditions are met. These conditions have not yet been clarified. Which brings me to number 4th exemption, that is branch profit exemption. Now, branch profit exemption will be available to the parent company under the proposed corporate tax regime with only condition that the foreign branch profits are subject to at least 9% tax in the foreign jurisdiction in which it is located. If any company opts for such foreign tax credit of branch, then it will be irrevocable on the company. When a free zone company is a holding company and substantially all its income is derived from shareholding in the subsidiary company which meets the participation condition as discussed above, then capital gains earned by them will also be exempt. Which brings me to the last exemption. Income earned by a non-resident from operating or leasing aircraft or ships used in international transportation will also be exempt, subject to a condition that the same tax treatment is granted to a UAE business in the relevant foreign jurisdiction under the reciprocity principle. So majorly 4 exemptions have been allowed from the UAE corporate tax regime, which is related to the branch profit, subsidiary company, dividend and capital gain, and lastly which is related to leasing an aircraft. With this, I would like to talk about the most debatable and interesting element, which is the deduction of expenses. Now the income will be calculated following the general accounting principles, but in order to curb the inadmissible expenses, the proposed UAE corporate tax regime will disallow or restrict the deduction of certain expenses. This is just to ensure that relief can only be obtained for expenses incurred for the purpose of generating taxable income and to avoid excessive or unreasonable deduction of expenses. Though the public document has not clearly stated what will be deductible and what will be not, it has specified certain elements which are included while preparing the financial statement as per the accounting standards. Very first comes the interest and other financing charges. There are certain notable points to be kept in mind for interest and financing charges. Very first, to prevent different tax treatment of equity and debt being exploited through the use of excessive levels of debt, the proposed UAE corporate tax regime will cap the amount of net interest expense to only 30% of the EBITDA, that is the earnings before interest, tax, depreciation and amortization. Now this is also in line with the interest limitation proposed by OECD's BEPS erosion and profit shifting project, which have been implemented by countries around the world. However, to reduce the administrative burden, businesses may be allowed to deduct up to certain amount of interest expenditure irrespective of 30% of EBITDA rule. Now what will be allowed? That we can come to know only when the actual law will come into existence. Next comes the interest capping rule will however not apply to banks, insurance business and other regulated financial service entities, as they already have another norms and regulations to fulfill under their respective laws. Also, interestingly, the businesses which are being carried on by natural persons, interest and financing charges rules will not apply to them also. That is, they can claim interest exemption up to the amount they have actually incurred for such expenses. Businesses that are part of a consolidated group can apply different interest capping rules in reference to group's financial positions. And lastly, interest paid on related party borrowings should be at arm's length price, where such borrowings are used for certain specific intragroup transaction. In addition to that, such related party interest will be deductible only if there is a valid commercial reason for obtaining such loan. Now, valid commercial reason will be considered to exist if the related party is subject to corporate tax or an equivalent tax of at least 9% on the interest income earned is being levied. As discussed in the earlier videos, the related party payments made to a free zone person, that is taxed at 0% on the receipt of income, will not be deductible to corporate tax purpose. However, the related party will be allowed to claim deduction if payment is attributed to a mainland branch of a free zone person. It brings me to another element of expense, that is the interest expense incurred for customers, shareholders, suppliers and other business partners. Now these expenses have a personal and non-business element as well, and due to that businesses will be allowed to deduct only up to 50% of such entertainment expenses while calculating the taxable income for corporate taxation. Further, no deduction will be allowed for certain administrative penalties, recoverable VAT and also donations paid to unapproved charity or public benefit organizations. With this, it brings me to the conclusion of today's video. In the next video, I shall discuss on treatment of losses and treatment of groups under the corporate tax regime. I hope this video has given you an idea about calculation of taxable income. Till then, stay tuned and do like, share and subscribe to our channel to never miss any upcoming video. And for any queries, do feel free to reach us. Our website and other link is shared in the bio. Thank you and keep smiling.